To the next segment of our video series on credit and credit scoring. My name is Kurt Jackson. I'm a certified mortgage planner in Liberty, Missouri, a 17-plus year veteran in the mortgage industry. And in this segment, we're going to try to go deeper into the actual credit report. But before we continue, I got to give you our disclaimer. We're not attorneys. The information that we share is not to be construed as giving legal advice. The information in this video series is designed to alert you to different aspects of your credit bureau and how you can fix it. And if you decide you need to repair it or to make sure things are accurate, you can always consult with an attorney to make sure that it's done correctly and you're staying within the laws of your state. A credit report includes three types of accounts and debts. There's trade lines, and those are the original creditor, like something like a Bank One, a Macy's, a Washington Mutual, a Bank of America. There's third-party collections, and these are collection agencies that actually buy delinquent loans or delinquent debts from the original creditors. And then there's public records, such as tax liens, judgments, those types of things. I want to review how the score is impacted when you pay off these different types of debt. Trade lines. A past due amount has one of the most devastating effects on a credit score of any factor. If there's a past due amount that is not yet turned into a collection or a charge-off, this debt, if possible, should be paid immediately. The credit score will improve when the past due balances go to zero with all the three credit bureaus. If there are charge-offs, a debt which is written off to profit and loss but retained by the original creditor, and collections kept by the original creditor, the story becomes more complicated depending on the credit bureau involved. In general, when you pay off a charge-off or a collection, the credit scoring system considers the payment an activity and thus updates the delinquency, lowering the credit score. So unless a lender requires that a collection or a charge-off be paid before closing, we don't advise you to do so unless you're prepared to wait 6 months or more to obtain the loan. Of course, if it's hurting your score enough, it makes sense to go ahead and pay it off and wait. Now, sometimes a creditor will settle a charged-off account, and there are a couple of pitfalls. However, there are in settling. Some creditors will charge off the balance of the debt that was not paid. So if you had a $10,000 debt, you settled for $6,000, it could be reported as a $4,000 charge-off after the settlement. American Express reports this way. In such a case, the settlement is not really an advantageous move to the credit score because it generates a new serious delinquency. And for this reason, any settlement reached should be settled in full or satisfied. Also, the IRS treats amounts saved by a borrower in settlement as income, and in their eyes should be reported as income. The scoring system treats a settled account the same as a paid collection. Now, when it comes to third-party collections, a credit score reflects the date the account was sold to the first collector. Keep that in mind, folks. That's very important. This date is used to calculate the 7-year aging period. If it's an old debt and the borrower has limited cash, that cash could be better applied to other accounts to raise scores, such as lowering the balance to limit ratio on a revolving account. If you pay off a debt to a collection agency, it does not increase the score, but leaving it unpaid does not lower it either, all right? It gets better and better the farther out. Your score improves the farther out you are from that collection. This leaves room for negotiating with a collection agency that, of course, wants to be paid. The best result is to delete the account, and this almost always requires payment in full and a good reason for doing so, such as a documented request for an address change that the credit received but did not process correctly, or severe illness, or something along those lines. The art of negotiation is important here, and the facts of the individual case are important. A collection debt can often be settled for less than the original amount, unless it's a utility bill such as telephone or gas. Normally they're going to want the entire amount. Public records. If there's no effect on a credit score for paying off a judgment or a tax lien, judgments stay on a credit report for 7 years, whether satisfied or not, and tax liens remain for 7 years after the date it's paid. Tax liens, therefore, should be paid as soon as possible, with a release of lien obtained and filed with the county recorder's office immediately. Similar, if a judgment is paid, the borrower should obtain a signed acknowledgement or satisfaction of judgment and then immediately file it with the court. So in summary, what should you pay and when? Things to pay immediately. Borrowers should pay past due balances on trade lines, which are revolving and installment accounts, as quickly as possible and obtain confirmation of that payment. If one of the past due accounts is a mortgage, tell them to pay this first, all right, because the simple lender psychology of when approving a loan. The objective is to keep an account from being charged off, moved to a collection status, or sold to a third-party collector. All of these have devastating effects on your credit score. Things to pay in escrow. If a lender's requiring a charge-off to be paid, see if you can pay it in escrow so you can avoid lowering your credit score before the loan closes. If a tax lien must be paid out, but money is tight and there are high balances on revolving credit amounts, a borrower maybe should pay down the balances to raise their credit score to obtain a more favorable loan rate and then pay the liens out of escrow, assuming you've got enough money to do all of this, thus increasing the loan amount if possible and if necessary. Things that you should pay whenever: a third-party collection or a judgment can be paid any time if payment is not required by the lender. If the 7-year statute of limitations is nearing, the debt will drop off the report anyway. Therefore, the timing of the loan may be a factor for you. It might be that waiting a few months would lead to a cleaner credit report. Now, folks, this is for people that are heavily in debt. And once again, this isn't legal advice. This is just what we've found in practical experience. If you're heavily in debt, we want you to think 3 times before filing bankruptcy or going to a debt consolidator, you know, the ones that are always advertising on TV, or signing up for credit counseling. Why is that? Well, let's go through that. First, bankruptcy. While making the debt magically disappear, it remains on your credit report for 10 years after filing. Credit scoring aside, a bankruptcy may affect one's attractiveness to a lender, an employer. That can affect your earning ability, or even a landlord. The best reason to file bankruptcy is to protect a home, but there may be other reasons to resolve, or other ways to resolve the debt. The debt consolidation industry is rife with fraud and scams. Now, I'm not talking about, you know, you coming to me for a mortgage and we do a debt consolidation type loan. These are a different avenue. These are the ones that say you can, you know, consolidate your debt without getting a loan or without refinancing. Those are the type of guys we're talking about here. Because see, these consolidators, they typically want a large upfront payoff. It may be months, if at all, before any payment is made on an account, thereby risking delinquencies, charge-off, and collections, all of which we've already talked about can seriously affect your credit score. Consolidators will usually try to negotiate a debt down to a fraction of the original amount and make lump sum payments from available cash. Some debt consolidators will require you to sign papers without telling you that you're actually filing for a Chapter 13 bankruptcy. See, consumer credit, so stay away from the debt consolidators. There's just nothing really good that can come out. Those are all things that you could do on your own if you wanted to, and make sure that that money is going to the right places to pay off those debts, because the debt consolidators are going to keep a bunch of your money that could have gone to paying off that debt. Consumer credit counseling, it sounds like, oh, that's the great thing, and they're usually not for profit, which is always supposed to be good. But unfortunately, it's typically financed by the large financial institution, and they're committed to paying off the entire debt. Think about it. If they're being funded by the banks that gave you the credit cards, don't you think they're going to want to get that money, and the credit counseling is going to help them get their money? Now, these companies will offer to lower your interest payments. Payments will continue for several years with an additional monthly management fee. And by the time the debt's paid, you've paid out much more than the original debt, and you've lost control of managing the accounts. And it's not uncommon for counseling agencies to be late on payments with the delinquencies appearing on your credit, and once again lowering your credit scores. I've known this for several years. I've always advised people to stay away from credit counseling agencies. They are not there to help you. They are there to help the banks. So heavily indebted customers may be better off trying to arrange their own payment plans and settlements to stay in control of your debt and stay in control of your credit. The bottom line is, if you're heavily in debt, you need to be really careful, because you're swimming in shark-infested waters, and frankly, you bleed easily. Your best bet could be to get with an expert in evaluating your options regarding credit, whether you own a home or not. And that's something that we can help you with if you so desire. And you can contact us at the information listed on the screen. And remember, if you have any questions or comments on this segment, email us or call us at the numbers on the email address or the numbers on the screen. And thank you for tuning in to our video series, and make sure you tune in to the next segment. Thanks for watching.